Hello, welcome back to this week's market update. Today is Monday, April 8th, 2024, and we had a very exciting week full of a great jobs report as well as some other economic data, so we'll jump right in. Looking at last week's market performance, stocks ultimately fell despite a rally on Friday from the unexpectedly strong March jobs report. As of close on Friday, April 5th, the Nasdaq Composite was down 0.8% on the week, the S&P was down almost 1% on the week, the Barclays Aggregate Bond Index down about 1.3% on the week, and the Dow Jones Industrial Average down 2.3% on the week. Heading into our market news of the week, we got the jobs report for the month of March on Friday, and this was ultimately the biggest news of last week. We saw non-farm payrolls rise by 303,000 in the month of March, which was almost a time and a half, more than a time and a half of the anticipated 195,000 that was expected of job gains. We also saw the unemployment rate fall slightly from February's 3.9% here to March's 3.8% versus the 3.9% that was expected. Average hourly earnings also met expectations with a monthly increase of 0.3%. So ultimately, when we're looking at this and the job market and all of the labor market data that we've gotten, the unemployment rate has been in this range of 3.7 to 3.9% since August of 2020. So that's a pretty steady rate. Anything below 4% shows a pretty healthy labor market. So ultimately, this shows just another month of really strong labor gains and a overall positive U.S. economy, at least in terms of the unemployment rate. Last week was also a week that we got the ISM Manufacturing and Services Indexes. So looking at the ISM Manufacturing Index, it was the first month that the index creeped above 50 for the last 16 months of contraction. So here you can see March's index came in at 50.3, up 2.5 points here from February's index. And again, this was the first positive month of expansion in the manufacturing sector after 16 consecutive months of contraction, which means that all the readings were below 50. So looking at this, it is a really positive sign of the manufacturing industry. We've seen in the last few months, it's gone from, kind of more like 46, 46, 46, 46 up to 47, 49, 47. So it may be creeping up. It may be a one-off trend in the month of March. The ISM Manufacturing Index crept up to be positive, or it could also be the initial signs of a upward trend for the manufacturing industry. Alongside that, we also got the ISM Services Index, and this showed a little bit of a different picture, but still positive. We got the ISM Services Index for the month of March at 51.4, which was slightly lower than expectations, but it does still mark the 15th month of consecutive expansion with growth occurring, aka readings above 50, in 45 out of the last 46 months, with the only contraction being in December of 2022. Then when we look at the average for the 12 months, we're at about 52.5, which again is quite positive and strong for an ISM Services Index between a range of 54 to 50.5. So overall, great news on both the ISM Services and Manufacturing Indexes for the month of March, and we'll continue to watch them to see how these trends change and how different services and manufacturing companies are affected by the economic activity and the outlooks in each of those industries. Continuing through our week, this is actually the last scheduled data point that we'll take a look at here, and one more statistic in the next slide. But we got consumer credit for the month of January, the first reading of 2024, and that showed a 4.7% increase in the amount of total credit outstanding. Then when we break that down between revolving and non-revolving, revolving, which is things like credit cards, personal lines of credit, typically things that people in more difficult financial situations rely on for carrying a balance on. That rose 7.6% from a year ago. And then we saw non-revolving credit, which includes things like car loans, student loans, those sorts of things, mortgages, that rose 3.6% from a year ago. Both of these indicate just continued borrowing, and that could be a sign of confidence in the economy that consumers think that they can pay these things off, or it could also be a sign of weakness in that consumers are having to take out more debt to just, meet day-to-day expenses. But one other really interesting thing that I looked into when we were reviewing the economic data of last week was the delinquency rate on credit cards, which is often looked at pretty consistently when there are concerns of a recession because it typically rises in a recession depending on the strength and the magnitude and the type of recession. But we have been on the rise, just a trend I wanted to point out. Again, very, very low compared to the 7% delinquencies we saw in the 2008 crisis. But we have been on the rise of people defaulting on their credit card loans. So, just an interesting data point as we take a good read on how the consumer is doing. A final update of our week comes from some news in layoffs. So, just taking a quick look at kind of where we are in terms of historic layoffs versus the current quarter. So, this is technology layoffs since COVID-19. Obviously, that peaked during 2020 when COVID first started. Then we saw that rise in layoffs in leading up to a peak in the first quarter of 2023. So last year we saw over 150,000 layoffs and over 500 technology companies with layoffs, and that has kind of fallen down since. But one really notable layoff update in corporate news is that Apple had their first round of layoffs last week. Over 600 employees that were believed to be on their autonomous driving electric vehicle team. They recently canceled the project, and so from some state filings, there is speculation that these 600 employees that were laid off last week were on this team since the project was completely canceled. So Apple was the last company actually to announce any layoffs in terms of Microsoft, Meta, Alphabet, all of the large technology companies. They all had layoffs in this period in kind of 2022, early 2023. Even Amazon recently announced some more layoffs, but Apple has been one of those companies that did not size up during COVID. They added some employees, but they didn't overhire like many of the other technology companies. And so they've always been a more lean company in terms of staffing. But this does mark their first round of layoffs. Thank you for tuning in to our market update this week, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.